I do not wish to repeat the same mistake for a second time. Only by learning from our mistakes and transforming them into future profits can we truly forgive ourselves for those errors. I once again lost everything and was thrown out. Not only that, but I felt that I could never win this game again. I became so disillusioned that I even considered quitting, leaving New York to find another job somewhere else. Every fall inevitably forced Jesse Livermore to reevaluate the market, his mistakes, and himself. He had to find effective solutions. Otherwise, he could not surpass himself or make a comeback. Born in 1877, he was a legendary figure who spanned 2 centuries. Jesse Livermore, hailed as the king of traders, is one of the most influential masters of the modern investment and trading field. Have you heard of him? In my view, he can be considered one of the greatest short sellers of the last century. He once shorted the entire U.S. economy to such an extent that financial magnates like J.P. Morgan and the U.S. government had to plead with him to stop, claiming that the entire national economy would collapse if he did not. However, this is not what he is most famous for. He earned the title King of Traders because of his trading philosophy. If you want to gain a deeper understanding of the secondary market, trading, and stock investing, I recommend a classic book, Reminiscences of a Stock Operator, written in semi-autobiographical form. The book tells the story of Jesse Livermore's trading strategies and ideas. Despite being nearly a century old, the content remains as relevant as ever. The essence of trading lies in human nature. To beat the market and achieve excess returns, one must first conquer one's own irrationality. He was born into a poor family in Massachusetts, USA. At the age of 14, he left home with only $5 given by his mother, beginning a life full of ups and downs and legends. In those days, there were places in the United States called bucket shops, which were essentially gambling dens for financial derivatives, where people could bet on whether a stock would rise or fall, without actually buying the stock. While working odd jobs, Livermore became fascinated with stock prices. He would observe the price fluctuations in the bucket shops and record them in a notebook, trying to find patterns. He gradually discovered that stock prices usually fluctuated within a certain range. He then adopted a strategy of buying low and selling high, and exiting quickly once the price went beyond that range. With this simple strategy and his sensitivity to numbers, he was able to earn $200 a week. At 17, he easily spent $1,000 to buy his mother a house and became well known in Boston's bucket shop circle, earning the nickname the Boy Plunger. After 2 or 3 years, he had accumulated $10,000, which was a huge sum at the time, far exceeding his parents' savings. Thus, the title of Young Trader King rightfully fell upon him. However, Livermore soon found himself blacklisted by all the bucket shops in Boston, cutting off his source of income. So, he decided to head to New York, bringing his well-developed strategy into the real stock market, ready to make a big splash. But reality was not as he had imagined. His range trading strategy did not work in the real stock market. Why? We will discuss this later. Within a year, his $10,000 was completely lost. At 23, Livermore did not give up. He borrowed $2,000 from a friend and decided to make a comeback. He went to a small town in the Midwest, found another bucket shop, and hired someone to place orders for him to avoid being recognized. With this strategy, he once again made $5,000, not only repaying a loan, but also making a net profit of $3,000. However, his luck did not last long. He was discovered and blacklisted again. At this point, he realized that this kind of small-scale, sneaky approach was not sustainable. He decided to take a leap and truly enter the stock market. After in-depth research, he discovered that stock prices do not move randomly. There are key levels, such as $80 and $85. These levels are now known in modern technical analysis as resistance and support levels. Stock prices fluctuate in these ranges in the short term, but once they break through, they can continue to rise or fall. He realized that his inability to profit in the New York stock market was mainly due to 2 reasons. First, stock market prices change very quickly, while the prices in the bucket shops were lagging. Second, the actual trading costs were higher and liquidity was inconsistent. Therefore, he changed his strategy, no longer limited to low buy sell within the range, but focusing on the breakout points of stock prices. For example, if a stock broke below $80 and fell further to $78, he would short sell heavily, expecting it to continue falling and allowing him to make a big profit. This strategy is similar to buying on strength and selling on weakness, but it is much more complex and detailed. In the early and immature market environment at that time, this strategy might have been profitable. However, today's market participants are more complex, including institutions, government funds, insurance companies, and quantitative funds, and opportunities are fleeting. This upgrade in his investment philosophy helped Livermore enter a new stage of trading. At that time, the legendary financier J.P. Morgan's operations had caused the market to soar crazily. Livermore went with the trend and bought a large amount of stock. In just half a year, he turned $3,000 into $50,000. However, he sold out a position too early due to timidity, missing an opportunity to multiply his gains tenfold. This led him to establish his first important trading principle: do not rush to sell a profitable trade. Soros has said something similar. It does not mean that a profitable trade must be held forever, but rather that you should fight against your intuitive human nature. When a trade is profitable, most people will want to lock in the profit quickly, fearing that it will be lost again. However, this principle reminds us to fight against our instincts. After making a fortune in the stock market, Livermore confidently entered the cotton futures market, only to lose more than half of his $50,000. A crucial reason was that he was reluctant to cut his losses when they were small, hoping to recover later, which led to even greater losses. This led him to establish his second important trading principle: immediately stop losses on trades that are not looking good. This principle corresponds to the first one. If a stock falls after purchase, most people will hesitate or even consider buying more to lower the average cost, hoping it will go up again. After all, most people are unwilling to take losses. The core of these two principles is to fight against human instincts. Only trades that are based on rigorous analysis can succeed in the market. If a trade is profitable, it means that the analysis is likely correct, and selling it might forfeit the opportunity for even greater profits in the future. Similarly, if a trade is losing money, it likely means that the judgment was wrong, and not stopping the loss will probably lead to even greater losses. Of course, this is based on the premise that you conducted a serious analysis, rather than blindly following trends or listening to rumors. As time went on, Livermore's trading strategies and ideas continued to improve. He gradually accumulated a fortune of $100,000. In 1907, many investors lost confidence in the market and withdrew their money from banks. Livermore, following his second stage strategy of going with the market, took this principle to the extreme. He believed the market was about to collapse, so he shorted aggressively. As expected, the U.S. stock market plummeted, losing half of its market value. He made a fortune. The U.S. government, fearing an economic crisis, turned to J.P. Morgan for help. Morgan, realizing that Livermore was still shorting, approached him and asked him to stop. Livermore, considering Morgan's stature in the American financial world, decided to give him the benefit of the doubt, closed his short positions, and went long. As the government and bankers vigorously intervened to stabilize the market, it began to recover. He made $1 million in just one day, bringing his net worth to $5 million. This move made him famous. However, human weaknesses like arrogance and complacency once again became his stumbling blocks. The year after making a fortune, he entered the cotton futures market again. A friend known as the Cotton King gave him some inside information, advising him to go long on cotton. Although he was skeptical, he still leveraged up and bought cotton futures. Unexpectedly, the Cotton King and other suppliers colluded to liquidate their cotton holdings, causing cotton prices to plummet. Livermore went bankrupt again, a blow that was extremely severe. Thus, he added a third principle to his trading philosophy: do not blindly trust others' words. Think independently and do not casually listen to rumors. He borrowed from friends once more, hoping to make a comeback. At this point, he was already 39 years old and more cautious than ever before. For 6 weeks, he did not make a single trade. Instead, he patiently waited, studied the market, and looked for the right opportunity. During World War I, when metal demand was tight, he invested a large amount of money in the stock of a steel company. He bought in at $98, and the stock price rose to $115. However, he did not rush to sell, but continued to increase his leverage. When the stock price reached $145, he sold decisively, making another huge profit. His trading strategy became more sophisticated, and his wealth continued to grow. He gradually mastered the game of the stock market and reached his peak. Later, he re-entered the cotton futures market. This time, he fully understood the patterns of the cotton market, squeezed the market through futures buying, and won big by leveraging public opinion. The following year, he even made it nearly impossible to buy cotton in the market. The U.S. government became anxious, fearing another economic crisis, and sent people to communicate with him, hoping he would stop his operations. Livermore knew when to stop and cease his short selling. After that, he entered the wheat and corn markets. By 1925, at the age of 48, Livermore's net worth had reached tens of millions of dollars. In the second half of 1925, many stocks showed signs of high-level fluctuations, and he keenly sensed that a crisis was imminent. This was a once-in-a-lifetime opportunity for him. To avoid drawing attention, he hired over 100 brokers to short sell gradually. On October 29, 1929, known as Black Tuesday, the U.S. stock market suffered a devastating crash, triggering the most severe economic depression in American history. However, Livermore made $100 million on that day. At that time, the total revenue of the U.S. federal government was only $4 billion. On Black Tuesday in 1929, the U.S. stock market suffered a catastrophic crash, triggering the most severe economic depression in American history. However, Livermore seized this once-in-a-century opportunity and defeated the market with his lifetime of trading experience and wisdom. Amidst the desolate market environment, he made a name for himself and earned $100 million. Despite this, profiting from a national crisis is undoubtedly a morally questionable act. Many financial institutions at the time, such as J.P. Morgan, lacked effective constraints and regulation. We will not delve into the moral aspects. However, it cannot be denied that Livermore's wealth made him virtually as rich as a nation within the United States. Yet, his life was far from happy. His second wife was an alcoholic who constantly drank excessively. On one occasion, after an argument with her son, she shot him, nearly killing him. After divorcing his wife, Livermore found himself suffering from amnesia in his career. Following the economic crisis in the United States, the Securities and Exchange Commission was established. This regulatory body made it impossible for him to continue many of his operations. In 1934, the former billionaire Livermore went bankrupt again. The reason for his bankruptcy remains a mystery to this day. This time, he was unable to make a comeback and even suffered from depression. At the age of 63, he chose to end his own life. This was the life of Livermore, who had left home at the age of 14 with only $5 given by his mother, experienced 3 major ups and downs in life, and went bankrupt 3 times. He never took a penny from investors and earned $100 million on his own. Unfortunately, he failed to adhere to his own principles, leading to his eventual bankruptcy and suicide. Human nature is actually the most difficult to conquer. Livermore cannot be considered a successful and great figure, but his influence on future generations is very significant. His trading concepts are still used by many institutional investors and stock traders today. His last trading principle is, markets are never wrong, opinions often are,